Hi, I'm Tom Elliott with the April Investment Market Update for Beulah Capital. Well, it's fair to say that share markets thus far during April have been somewhat mixed. Now, Chinese economic data came out a couple of weeks ago. People had high expectations of the Chinese economy, expecting it to grow at around about 8% per annum. Well, the figures came out and usually by any comparison they were good. However, they did miss expectations. The Chinese economy at the moment growing at just 7.7% per annum. Anywhere else in the world we'd be thrilled with 7.7%, however in China we need it to be growing faster. The share market's taken a bit of a beating because resource stocks have taken a beating, and of course we've seen Rio, BHP and in particular Fortescue Metals being sold down quite heavily at the moment. Fortescue in particular is out of favour because it only sells iron ore, whereas BHP by contrast is a far more diversified minerals company. It's for that reason in our main portfolio we don't tend to hold Fortescue, we do hold BHP and Rio. Rio of course does derive anywhere between 60 and 70% of its profits from iron ore, so it is one that is more affected by any downturn in the iron ore price. But the selling in resource stocks has been fairly indiscriminate. Again, people just very worried about China. Also, the gold price has taken a real beating recently. I must say personally I'm a bit surprised at this. I think with all the money printing going on around the world, whether you look at Switzerland, the US, Japan in particular, you would have thought eventually we get a bout of inflation, and when inflation goes up the gold price tends to go up. Having said this, gold has been in an uptrend for quite some time and it's probably due for a correction, and we're certainly seeing that. Gold prices have come off anywhere from 100 to 120 US dollars an ounce, and shares now biggest gold producer Newcrest, which we don't own because we think it's just too specific. We don't like buying gold just by itself. Newcrest shares have been sold off. Having said that, it hasn't been all bad news. Infrastructure stocks have been particularly good. Telstra, if you can call it an infrastructure stock, and I would argue that it is, hit a 5-year high in recent days. It's signed a $1 billion deal with the Department of Defence, and that suggests that there is some more growth in the pipeline for Telstra. We also like Investra. It's a stock that we've put into our takeover target portfolio. Investra has a near monopoly collection of gas pipelines and a very well regulated return. All it needs is that people keep using gas, and I don't think there's any sign of that changing anytime soon. Investra has recently done a capital raising at 99 cents a share, and we think subscribers, or people at least if they own Investra shares, should subscribe for extra shares at 99 cents, something that we'll be doing. But going back to other stocks that are in the oil and gas space this time, we've decided to remove Origin from both our income portfolios and our main portfolios. Origin is an excellent company and it does have that sort of infrastructure aspect to it with its electricity and gas businesses. However, it's got a massive LNG project up in Gladstone in Queensland, and it just seems that the cost blowouts in these projects, thanks to the high Australian dollar and the high cost of employing local workers, means that we just don't know when this project's going to come off or how much it's going to cost. So we've decided to remove Origin from the portfolio. And also Woodside Petroleum on the other side of the country has had a similar problem with its Browse project. It seems that the onshore LNG terminal it hoped to build is just going to cost too much money. There were numbers of 40, 50, even $60 billion being talked about. It's not going to go ahead, and shareholders in Woodside might, and I reiterate, might be rewarded by perhaps some sort of return of capital if the company isn't going to go and spend all of that money. Some other stocks we've been looking at recently in the sort of infrastructure and transport sectors. Toll Holdings is a stock we've put into our main portfolio. We think that if there is some resumption of better growth in the Australian economy, and post the federal election in September 14, I expect that that might actually happen. Toll Holdings is very well placed. And another stock that we've put in our takeover portfolio is Cube Logistics. Now, that's run by Chris Corrigan, excellent business, and it's got a big parcel of undeveloped land around the Sydney port area that we think could add to the stock's value in a few years' time. So overall, it's an interesting time now. You've got to be very, very selective about stocks at the moment. Resources, probably worth staying away from now until the Chinese growth trend is re-established, and who knows if that might happen. As always, a very good idea to look for yield and sustainable yield. Look for stocks that can keep paying their dividends, because in an environment of very low interest rate, that's what people want. All right, thanks for your company. Look forward to doing it again next month.